Welcome and thank you for joining today's conference, U.S. Small Business Administration. Please note that all participant lines will be muted until the Q&A portion of the call. We'll provide you with instructions on how to ask a verbal question at that time. You are welcome to submit written questions during the presentation, and these will be addressed during Q&A. To send a note, please select the Participants menu at the top of your screen and opt to send note to all presenters. If you are logged in using the web-based application, use the Notes function on the lower right-hand side of your screen and adjust your note to all moderators. With that, I'll turn the call over to Michelle Genovese. Please go ahead.
Hello, everyone, and thanks again for making today's call. You know, we have a lot of information being released as far as the SOP, the web, franchise. A lot of changes coming up in January 1st, and we're going to be having our next Lender Connect call, hopefully on January 9th. So I'm going to turn it right over to John Miller because we've got a long call.
Okay. Good afternoon, everybody, or good morning for you on the West Coast or further west. I will give you a quick update on the lending activity that has taken place during the first month of the fiscal year. So what you see here are the charts for the lending activity of October 31st, as of October 31st, compared to last year and every year back to 2013 as of October 31st, not as of the end of 2017, but as of the end of October of each of those years. So as you can see, we're up in both 7A and 504. 504 got off to a slow start last year compared to the previous year, and we were about where we were back in 2016, so off to a good start. Next slide, please. Small dollar loans, encouraging. We are way up in small dollar loans in 7A, and so as of we're up about 10 to 15% in the number of small dollar loans over where we were last year. So that's encouraging. Export loans are down. Could be a seasonal thing. As you know, the total number of export loans by the end of 2016 was actually higher, for 2017 was higher than it was in 2016. And SBA Express is up.
I'm trying.
Underserved markets, we're up across the board except for veterans. So we'll be looking into that. As you know, the fee waiver was at its peak for veterans in 2016, and in 2017 there was a little bit less available for veterans, as well as this year further available still, and unfortunately that does have an impact. But it also has a big impact on loans that are made to vets that don't qualify for fee waivers, because people don't always take the time to report that it's a veteran loan. So we've got that working against us as well. As you know, our reporting is voluntary on the part of the lender and the vet. Next slide, please. And that's it. Thank you all. That's all I have for you today.
No scoops?
No scoops. You know, thanks for everything you're doing. Keep it going. You're going to be hearing a lot, as you know, coming from the administrator and others on the whole SBA Reimagined. So keep moving the needle forward. We appreciate it.
Thanks, John. John, did you want to introduce our new employee here?
Yes, I'd love to introduce Bill Briggs. Bill Briggs is our senior advisor to Bill Manger in the Office of Capital Access, and he joined us just a couple of days ago. So he is here to support the office and especially Bill Manger. And so please give him a chance to say a few things about himself, and welcome aboard, Bill.
Great. Thank you, John. And thanks, everybody out there. It's my third day, so we're still getting used to everything here, but I'm looking forward to it and looking forward to working with you. This is my second time in government, and I respect the work that we do all across the country and throughout the regions. And looking forward to being a big part of the team, particularly with the administrator's new direction of SBA Reimagined. And I'm sure you'll be hearing more about that in the coming days and weeks. But I'm looking forward to working with you. And if you have any questions, feel free to reach out to me. My email box is always open.
Thank you, Bill. And I know he's pretty sharp. He already saw one mistake I made in that slide deck today. So I'm thinking he's pretty smart. But thank you so much for being here. Steve O'Lear, you're next. Are you on the line?
I am, Michelle. Thank you.
Thank you.
Are you going to advance the slides?
Yes, I am.
Oh, perfect. Okay, great. Okay.
And I'm going to start it right on that franchise directory slide for you. So you're take it away.
Great, thank you. So I'm sure most of you have seen the changes that we made in the 5010-5J version of the SOP. So I'm going to talk about some of the changes now. But before I did that, I just really wanted to clarify where we are today and just remind everyone, to remind the lenders that the process that we're going to talk about today is not effective until the 1st of January. So everybody needs to understand that the process currently in place today is the process that we're going to use to the end of the year. I just wanted to clarify that process. There seems to be a lot of confusion still out there as to what the process is today, and I just really quickly wanted to go through that. Remember that effective in February, with our change in the policy, we now really have two addendums that a franchisor can use. They can either use the standard addendum, the SBA Form 2462, or they can use the negotiated addendum. And the negotiated addendum is an addendum that was negotiated by SBA in either 2015 or 2016. But remember that the applicant franchisee, whatever agreement that they're using, does not need to match that date. There'll be a lot of confusion about that issue as to whether or not they can use that in negotiated addendum. So the best way to think about this is that the franchisor has a choice. If they do have a negotiated addendum, that means an addendum we created based on their 2015 or 2016 agreement, they can use it across the board on any agreement that they have, provided that they sign that certification 463, or they can use the SBA standard addendum. So I just wanted to clarify that because there seems to be continued questions about that matching up the date. So we're pretty much forgetting about the dates going forward, and especially with the new process in January 1st, we're totally wiping the dates away. But for now, the only date issue that you need to worry about is that 2015 or 2016 addendum, whether they have it, but they can use it on any agreement. Okay, so what are we doing going forward? We have created, the SBA has created its own directory. We're calling it the SBA Franchise Directory. I believe most of you probably have been able to get to it now. There was a bit of an issue with the revamp of the website, but I think it's I've seen a lot of folks send out the link out there. So it is currently listed now, and it's on the For Partners page. And if you don't have that link, I'm sure, Michelle, you can probably send it out, right?
Yes, I almost included it in here. Did I add it to the very last? I may have, but I didn't know if you wanted it released yet. So.
Yeah. So
sure.
I would have it, you can contact Michelle, and I think she can send it out, give it to so everybody can at least know where it is. So the directory is going to be maintained. That's not the correct website for it because obviously the website got revamped after we wrote it. So, but we will go ahead and in the version, I guess, that gets finally posted, put the correct links in there. So what will the directory do? The directory will determine if, number one, if the brand meets the definition of an FTC franchise. So the brand will basically say, the directory will list the brand, and it will determine whether it's an FTC franchise, yes or no, and then it will also determine other things. But we are going to make that determination. We are also going to list on there non-FTC franchise brands because, again, we're going to try to get as many brands on there as possible and identify them as whether or not they meet the FTC definition or not, so that the directory will have both on there as well. We are also now determining eligibility for the lender. So as most of you remember, the franchise registry, it dealt with affiliation only. It didn't specifically deal with eligibility, but our directory will. We will actually vet the brand for eligibility, and we will only put eligible brands on the directory. So if it is on there, the assumption is that it has been vetted for eligibility as well. SBA will be providing a franchise identifier code, which is a new code system, so we will no longer be using the funds numbers. However, the process currently in place today through the end of the year does use those numbers or whatever is in E-Tran, so lenders still need to be checking E-Tran and using that system. But going forward, we will be providing a new identification number that will be listed on our directory, and it will be also matching in E-Tran and SBA 1. So just be advised that the directory currently right now has no numbers on it. We did that purposely because, again, the directory is not effective until the 1st. But it will have identifier codes, and we will only issue an identifier code to a brand that has met the FTC definition. If it hasn't met the FTC definition, it will not get an identifier code. And the last thing we'll do on the directory is determine if an addendum is needed. So we are moving back to the system we had in place before January 1st, which means there are some agreements out there that do not require an addendum. For instance, the Best Western brand, while they are a franchise, they do meet the test. They are a membership organization, but they do not require an addendum. Currently, they are signing the 2462. They've agreed to do that even though they believe they don't need to. But going forward, they will be listed on the directory as an FTC franchise, but they will not be required to provide an addendum. Okay, next slide. So again, the new procedures are effective January 1st. And again, we'll be issuing those new identifier codes, and those will eventually show up on the directory as we get closer to the 1st. Lenders, the big thing here for lenders is that they no longer will have to review franchise agreements and other collateral documents for affiliation between the franchisor and franchisee, and they will not have to worry about eligibility as well. And again, it's eligibility of the franchise model, and this is something that we're making really clear to lenders, to lenders, that we are vetting the brand for eligibility. We are not vetting the applicant for eligibility. So, of course, they're still required to vet the applicant to make sure the applicant meets SBA's eligibility requirements. But as far as the brand is concerned, we are doing the brand vetting as well. So we're basically vetting for affiliation, determining whether or not it's a franchise, determining whether or not an addendum is needed, listing which addendum the franchisor is using, and we are only listing those agreements on the directory that are SBA eligible. Next slide. Quickly, we'll go through the definition of an FTC franchise. So the Federal Trade Commission basically has determined what meets that test. If you can go to the next slide. It's a three-part test. You need to have all three of these elements in order for an agreement to meet the definition of a franchise. The first element, we call that the trademark element. The agreement requires that the applicant operate under some type of branding mark or trademark or logo. So if you have an agreement that requires that the applicant operate under one of those, then we will go ahead and say it meets the first part of the test. So that's a pretty easy one to find. The second one is, does the franchisor exert or have the authority to exert significant degree of control over the franchisee's method of operation? And it's the method of operation that we're focusing on here. So basically what we're concerned about is, does the franchisor have the ability through its agreement or other document to tell the franchisor how to operate their business? So what are you looking for? Does the franchisor require that they operate under some type of manual? If they provide a manual, that's pretty much an indication that they're controlling the method. Are they controlling the hours? Are they setting what hours the business needs to be open? Do they need to approve the location? Do they require that the applicant have uniforms? these are the kinds of things that deal with methods of operation. So if the agreement provides for those sorts of things, then potentially we're saying that it'll meet the second element. And then the last one is the fee. This is a more difficult one. It's a very broad, the definition of what is considered a fee is very broad in the eyes of the FTC definition. Basically, if there's a required payment, and that required payment is $500 or more, so it's a pretty low bar. $500 is not a lot of money. If that payment is required to be made within the first 6 months of operation, then it meets that payment element. And so what could that be? Well, it could be potentially the royalty fees. It could be the franchise fees. But also it could be anything that the franchisor requires the franchisee to do. For instance, point-of-sale systems, if they're required to buy that, if they're required to buy signs, anything that the franchisor is saying that they need to buy or that they need to pay for prior to opening or within the first 6 months of operation meets that test. So if a agreement contains all three of those, then it meets the FTC definition. So what are some that haven't so far? Well, we've looked at a lot of the agent agreements for insurance companies and determined that they don't meet the FTC definition because they don't have a payment element. We've looked at the route systems for FedEx, and we've determined that they don't meet the FTC definition. So we're trying to get as many of them on the directory as possible. But in the meantime, between now and the end of the year, lenders are required to make that determination themselves. So this will help if you get questions about that as to what exactly the FTC definition requires. Next slide. The FTC, if they meet the definition of a franchise, then they have to provide a disclosure document. There are exemptions to that disclosure requirement, and that's fuel supply agreements. So we're basically saying fuel supply agreements that are covered by the Petroleum Marketing Practices Act, that's the PMPA, are franchises under the definition and require a review of whether or not they need an addendum. So that's just pointing out that fuel agreements are considered franchises. Next slide. So the issues that create affiliation have not changed. We have not made any changes to those since the beginning since January 1st. So these are here in the slides for reference. I'm not going to go through them all just in the interest of time, but we haven't changed those. Those are actually what is listed in our standard addendum. So again, transfer, change of ownership, that's written there. Next slide. Sale of assets, again, those same issues are there. And next slide is the covenants and use restrictions. And again, remember that if they record any restrictive covenant against the property or environmental use restrictions, those are problematic. And then the last slide has to do with employees. And we have the issue that deals with temporary personnel agencies in there. And again, remember, for temporary personnel agencies, the employees need to be the employees of the franchisee. So none of that has changed. I just put that in there just so that you guys all can remember what they were. Next slide. This is a change, and some of you may know this and some of you may not, but there was a policy notice created back in 1964-65 that exempted new car manufacturers from review under affiliation rules for SBA financing. And that policy notice basically was not touched or changed for all these years. So when we revamped the system, we got a lot of questions as to why those folks were exempt and no one else, and we really didn't have any reason to continue to make that exemption. So we're basically saying that new car manufacturers have to go through the same analysis as anyone else. So there is no exemption for new car manufacturers. If there's an agreement, it needs to go through that test, and we will review those as well. So if any of those need to get placed on the directory, we will put them through that FTC test and decide whether or not an addendum is needed. Next slide. Multiple agreements. So we're just clarifying this is the critical test. Again, we haven't changed this. We're just bringing it back. It was something that was removed from the SOP in the last go-round, and we're just bringing it back. This is the idea of whether or not agreements are critical to the business operation, and if they're not critical, then we don't need to worry about them, A, being on the directory, or B, having to have an addendum. So the only thing we've changed here is that we've moved the test from 67% to 50% now. So all a lender has to do is qualify 50% of an applicant's agreement if they operate under multiple agreements, and we're basically talking an insurance company that operates under a number of insurance agreements, or like a dealer, that someone that sells RVs or motorcycles or things like that. If they're operating under a number of branded agreements, then they only need to have 50% of them meet the eligibility standard. So the interesting thing in this is that we're finding that more and more of these agent agreements or distributor agreements don't meet the FTC definition of a franchise. So again, the more of these agreements that we get on the directory, the better it's going to be. And I will tell you right now, we've already put Allstate as not meeting the FTC definition. State Farm, I think Nationwide, I'm not 100% sure, but we've gotten a number of those in. So again, the more that we get, the easier it will become, because lenders will be able to go on there and determine that they're not a franchise at all. Next slide. Development agreements. So we haven't changed anything on development agreements. We just clarified this issue a little bit. So just to refresh your memory, there's two types of development agreements or area development agreements. They're called a number of different things. So the eligible one is the one that allows a particular applicant to operate in a territory and open up one or more locations in a territory. The thing that makes it eligible is that it's the applicant themselves or an affiliate of the applicant that is actually operating the businesses. So while it does give them a territory, it does give them a right to develop the brand, the thing that makes it eligible is that it's themselves or affiliates of them that are opening those. And so that type of development agreement would be acceptable, would be eligible. The one that's not would be a third party is given a territory, and that third party acts like a sub-franchisor, where they go out and recruit non-affiliated entities to open up franchise units. And then their revenue is derived from the share of the royalty payments that get paid by those third parties. That would be considered an ineligible development agreement, and we would not be able to lend to that entity. Now, one of the things we clarified in the SOP is an eligibility issue that's come up a number of times, and it's a situation where you have an applicant that's operating, or an applicant that's applying for a loan that's opening a single unit franchise, and they may have an affiliate that is operating under an ineligible development agreement. So that does not automatically disqualify the applicant. So we're not saying that the applicant automatically is ineligible, but what we're saying is you still need to affiliate the ineligible affiliate for size purposes, but it doesn't disqualify the applicant. So that issue has come up a number of times, and we just wanted to clarify that. The other thing we're saying is that if you do make a loan to that individual entity, you have to ensure that none of the proceeds go to benefit the ineligible development affiliate. And we are saying that the fact that the ineligible development affiliate gets a share of the royalties does not make them ineligible. So we tried to clarify that in the SOP because it's come up a number of times. But other than that, the whole idea of development agreements have not really changed. Next slide. If you can go, past these, because I just talked basically about that. Great. Management agreements. So in July of last year, actually July of 2016, when we redid the affiliation reg, one of the issues that was identified as a cause for affiliation was management agreement. There really wasn't clear guidance about how to look at a management agreement, and I know there's been a lot of confusion out there as to how that operates. And again, this is not a specific franchise agreement issue, but it obviously does come up in a number of franchise brands, hotels in particular. And where it's also come up that we found that there's been a lot of questions about this issue is in situations that are medical-based franchises, and I'll use the joint as a good example because that was kind of the one that kind of started the process. So the joint is a chiropractic franchise, and the joint will allow a medical professional to own the business. So you could own a joint franchise even if you were not a medical professional, you were not a chiropractor. But there are a number of states that basically say you cannot, as a non-medical owner of a business, hire medical professionals and oversee them. So as a result, those franchises that are operating in those states are required to contract that service out, if you will, through a management type agreement. And so there was a lot, once this management agreement issue went into the reg, there was a lot of confusion as to, does this make these ineligible? Are these ineligible businesses? So we've decided that it is that they are not ineligible businesses per se, that basically what has to be done is that you have to analyze the management agreement under this new process that we put into place. So that opens up that issue, or I should say that clarifies that issue a little bit in terms of allowing these types of entities in there. So when we look at management agreements, we basically defined it into three pots, if you will. The first pot would be a management agreement that's so onerous that the business itself is a passive business, which is the first one that's up there on the slide right now. So businesses that have entered into a management agreement with a third party that gives the management company sole discretion to manage the operations of the business, including the control over the employees, the finances, the bank accounts, with no involvement by the owner, are considered passive. So if there's an applicant that's operating under agreement which basically turns over everything to that third party with no say at all by the applicant, we would say that that management agreement creates a passive business, and that would be an ineligible business. So if the agreement rises to that level, then it's not even an affiliation issue any longer. It becomes an ineligible passive type business. Next slide. So if it passes that test, meaning that it's not a passive, it doesn't create a passive type business operation, then we look to the management agreement as to whether or not it creates affiliation. And so we're looking at two standards. Does the agreement provide minimal oversight? Does the applicant have minimal oversight over the operation? Or do they have meaningful oversight? So if the management agreement gives the applicant owner only minimal oversight, then we are saying that that agreement would create affiliation, and then what the lender would have to do is look to the side standards when affiliate the management company with the applicant. If, however, the agreement provides for meaningful oversight, then we are saying it does not create affiliation between the applicant and the party management company, and there's no side analysis that has to be done in terms of the management company. And what is meaningful oversight? So meaningful oversight by the applicant business means involvement in the decisions made concerning the operation of the business, which include a management agreement that provides for the applicant business to do all of the following: approve the annual operating budget, approve any capital expenditures or operating expenses over a significant dollar threshold, have control over the bank account, and have oversight over the employees operating the business. The employees must be the employees of the applicant business. So if the agreement contains those four elements, then the lender can determine that applicant or that management agreement does not create affiliation between the applicant and third party. If it doesn't contain those and it's not 100% turnover, then it's probably minimal oversight, which then create an affiliation between those two parties. They would have to do the analysis. So hopefully this provides some analysis into the management agreement. And so basically when you get one of those chiropractic, if you will, businesses or any of these other businesses that potentially have that issue, then the lender needs to run that through the management agreement test and decide whether or not, A, it creates a passive business model, B, whether it creates affiliation, or whether it's not affiliated. So that's what has to happen. What we've done on the directory is we try to identify all those brands that potentially would have management agreements, and there's a footnote that will identify those on the directory. So obviously, the most popular ones are the ones that we've identified are the ones that are medical-based in some respect, and the hotels as well. And as many of you know, the hotels are a type of franchise model or system that potentially has the availability to have a management agreement. So what we've also tried to do is go through the hotel documents and make sure that none of those agreements potentially are conflicting. A lot of hotel brands don't have a management document. There are some that do. The one that I'm working with currently right now is Marriott. Marriott, as one of their collateral documents, has a consent to management agreement, which means it's an agreement that Marriott requires that gets signed if there's a management company. That consent agreement has a problem in it regarding the employee, so I'm working with Marriott right now to correct that. So hopefully by January 1, if a lender is making a loan to a Marriott hotel and they're using a management agreement, there won't be a problem in terms of getting that consent done. So we are trying to flush those out before we put them on the directory to make sure there's not going to be a problem. Next slide. The process for review of management agreements, and remember, management agreements are not franchise agreements. So management agreements will not get listed on the directory, so there won't be a process for a lender to ask us to review a management agreement and then say it's an eligible management agreement that doesn't create affiliation and put it on the directory because it's not a franchise agreement. So if a lender is making a non-delegated loan and they have the applicant operating under a management agreement, that needs to go through the LGPC, and the LGPC will make that determination as to whether or not that creates affiliation. Under the delegated process, the lender makes that decision themselves based on the guidance. Next slide. Franchisor certification. So one of the things that we're changing by listing that directory, by listing a brand on the directory and then using a negotiated addendum, they no longer have to use a 2463 and a franchisor certification loan by loan with every negotiated addendum. So we're basically getting rid of that requirement. If the directory says they have the ability to use a negotiated addendum, then they can use the negotiated addendum. There's no required certification on a loan by loan basis. However, we are requiring a yearly certification by franchisors, and that's directly with the SBA, not through the lender. And if a franchisor wants to remain on the directory with either having a negotiated addendum or not needing an addendum at all, then they need to certify that each year their agreement continues to operate that way. So that's an annual certification. The 2463 goes away, and we will control that process. We are also going to be doing an audit of franchisors to make sure that they are complying with our procedures. So that's something that we will be able to do, that we're doing internally through the use of the directory. So that 2463 goes away on January 1st. Next slide. We are now bringing back the ability of a franchisor applicant to be able to apply and be eligible for assistance. Prior to January 1, we had the global addendum process. We're bringing that back. So if a franchisor applies as an applicant, the franchisor has to meet the size standard, obviously. But also remember, the franchisees that operate under a franchise agreement potentially are affiliates of the franchisee based on that agreement. If that agreement affiliates them because of the control issues, then potentially you have to affiliate all the franchisees. Under the current SOP, there was no ability of a franchisor to sign any kind of addendum to prohibit that affiliation. We are bringing back the ability of a franchisor to sign a global addendum, which would then not make those franchisees affiliates, and if the franchisor are on their own, met the size standard, they could make a loan. So we're bringing that process back. Next slide. So the review process, if the franchisor agrees to use the 2462, it'll be a faster review to get them on the directory. The SBA will only conduct an eligibility determination. If the franchisor doesn't want to use the 2462, then we will now be able to negotiate addendums with franchisors if they're not happy with being able to do that. So if that becomes the case, then they can come into SBA negotiate with us on a case-by-case basis. So that brings us back to a little bit more flexibility in terms of getting brands on there that potentially were not happy with the 2462 and wanted to negotiate something that they didn't have before. Next slide. So upon completion of the review, we will again list the brands on the directory, but only the brands that are eligible, in making sure that if they meet the test, we're going to say that. If they don't, then we're going to say that they don't. Next slide. So what does a lender need to do for applications involving a franchise that meets the FTC definition? Before submitting the application to SBA for non-delegated process or requesting an SBA loan number for delegated processing, the lender has to check the directory to see if the brand's on there. So we are making a change to the process. Both non-delegated and delegated lenders basically all have to use the same process. The brand has to be on the directory to make a loan. For non-delegated lenders, they need to submit, in their credit write-up, the brand and the number, and the LGPC will confirm that the brand's on the directory. For non-delegated lenders, they need to document their file that the brand's on the directory, and then they go on. So there's no ability of a delegated lender to make the determination on their own. We're requiring everything go on the directory. Next slide. And again, procedure to submit applications. For non-delegated loans, all they're doing is submitting the name and the identifier code. They're not submitting any documentation to the center at all. There's no review at all in the center of any documentation. It has to be on the directory. If it is, they're just providing that documentation to the center. Next slide. For delegated loans, they have to document their file that the brand is on the directory. And the only glitch in this, or not a glitch really, but the only opportunity for a delegated lender to make a determination would be if they are making a loan to a brand that they believe does not meet the FTC definition of a franchise. At that being the case, they can look at that agreement themselves and determine that it doesn't, and they make the loan as if it's not a franchise, but that is subject to review in the center. So we're really telling lenders, you know what, send everything in and we'll get it on the directory and we'll tell you whether or not it is or it is not. But a PLP lender can make that determination if they want to, and they're sure that that agreement does not meet that. Next slide.
Steve, we have a question, and I just wanted to interrupt you because it does pertain to the process for these franchise. You indicated the lender must document in its file that the brand is on the directory. So we're suggesting that the lender just print off that directory and keep that in their file. Would that suffice?
That's a great question. So here's what we are working with. The tech people to be able to create a document where the lender will be able to go in, click onto the brand, and a one-pager will come out that will list the brand and date it as on the directory. So we're working with developing a product that will make it easier to do that.
Certification.
Thank you. And thank you, Jerry, for your question.
Okay. All right, great. So again, multiple brands, if the applicant's operating under multiple brands, the E-Tran and SBA 1 will only allow one number into the system. So we're saying that they need to enter the one that generates the largest amount of applicants' revenue in there. But they still need to identify in their credit write-up all of the other brands and the numbers. Next slide. If the applicant franchise has multiple locations and they each operate under a franchise agreement, then each of those locations and each of those franchise agreements need an addendum. However, if you have an applicant that already has financing and they already have an agreement and an addendum and you're giving additional financing, there's no need to get another addendum. So basically we're saying the addendum stays with the agreement as long as the agreement's in effect. You don't need an addendum loan by loan any longer. Next slide. So remember, we're telling lenders that while they don't need to submit anything up front for processing, they still need to ensure prior to disbursement that they have an executed copy of the franchise agreement and any addendum, and everything has to be executed correctly prior to disbursement. So again, that doesn't go away. The requirement of making sure they have the executed document before disbursement is still out there. They just don't need anything up front, but they certainly need to document it and make sure they have it before closing. Next slide. Procedures to add brands to the directory. The franchisor needs to submit the FDD. If applicable, and again, remember all brands don't have an FDD. The franchise agreement and any other documents the franchisor requires the franchisee to execute. Next slide. Great, we're done. So any questions? The mailbox that we're using now is franchise@sba.gov, so please send any questions there. And there's a team of 5 of us right now that are working on this process. So we're trying to move things really quickly to the box. We have someone managing the box, similar to the way you guys were doing it when Cap Access was managing the box. So send anything there. Franchisors will send their documents there as well. And I guess we'll get questions at the end of the presentation, right?
We can take some questions now if anybody wants to raise their hand or send it in. I know, Steve, I've already gotten a couple questions as far as how often will you be updating the website?
So prior to January 1st, we are probably going to do it every week or two as we add brands to the directory. We're checking right now with Steve Kucharski as to once we go live, whether or not we can do it on a daily basis, but it's going to try to, the intention would be we would try to update it on a daily basis once we go live in January 1st, but we're checking with Steve just to see what his team can do about that.
Okay. And Steve, will you, I didn't hear you mention this, I just wanted to confirm, franchise or that have been declined, or franchise?
Yes, that's a good question.
You know where I'm going with this.
I know where you're going with that. We are not able to publish declined franchises. So here's what we're basically saying to everyone. If it's eligible, it's on the directory. If it's not eligible, then it's not on there. And if a lender wants to check before they go through the process, and ask us, send something to the mailbox and we'll tell you whether or not we've seen it or it's eligible or not. So that's right now is the best we can do in terms of that. We will keep an internal list. Whether or not we can release that to the to the district, to the LRSs, we're checking to see if we can do that, so that they can basically help provide that. But we can't publicly list on the directory brands that we consider to be ineligible.
Okay, thank you. That's a good reason. Did you have another question? Oh, no. Does anybody else have any questions? Because I don't see anybody writing in any. Rita, can you ask and verify if there is anybody who would like to raise their hand?
Ladies and gentlemen, as we move to Q&A, please feel free to place yourself into the question queue by pressing #2 on your telephone keypad. VoiceOver computer users, select the Raise Hand emoticon from the top toolbar. You will receive a notification when your line is unmuted. At that time, please state your name and question. To send a note, please select the Participants menu at the top of your screen and opt to send note to all presenters. If you are logged in using the web-based application, use the Notes tab on the lower right-hand side of your screen and address your note to all moderators.
Thank you, Rita. And Steve, we already got one question here, and it is about 7-Eleven and the eligibility. How many times did you hear that question?
Right. So right now we have determined that 7-Eleven is not an eligible brand. Now, I do understand, and I have not seen this, but I do understand that they claim that there's another type of agreement out there that deals with gas. That's not their model. But right now we're saying 7-Elevens are not eligible. There's a credit elsewhere issue with them because they do, their brand provides financing. There's an open line of credit that they provide to all their franchisees. That business model is their business model, and that's what we're saying is a credit that they provide credit elsewhere. So as a result, right now we're saying we're not listing 7-Eleven and they're not eligible, but I've been told that there's some other agreement out there. So if that comes in, we'll be happy to take a look at that and see. But currently right now, 7-Elevens are not being listed on the directory.
Thank you.
You're welcome.
Rita, do we have any others with their hands raised?
There are no raised hand questions at this time.
All right, then we are going to move along right over to Bob Carpenter. Thank you so much, Steve, for being on the call today, and we'll reserve you for a little later just in case we have any more questions that come up. And Bob, we have some hot, not tropics, but hot topics. On the new SOP 50105J, it's all yours.
All right. I'll try to be a little happier on this call. I was told I was a little cranky on last month's call, so I'll try to convey a happier voice. For those of you who confronted me about that last month, you can tell me if I did better. Anyway, everyone should have been well versed in Information Notice 5000-17008, as well as probably elbow deep in the 50105J by now, reading it, trying to decipher what it changed and what did not change. I'm sorry we could not provide a technical issues or track changes version of that SOP because once we instituted it, it was really just a mess and it was very difficult to read and understand, so we just made the decision not to issue a track changes version of that document. We will be making some technical corrections before the effective date on January 1st, and technical corrections should not be interpreted to be a change in the policy that's there currently, only an update to correct any errors in format or hyperlinks that are embedded in the SOP. So this is not going to change the policy. So if you don't think a change in the policy was a good idea, I'm sorry, but we're not changing it. And whatever the 5010J says, that's what it's going to be. We may provide some clarifications, some facts on the policies that are causing some confusion, but we are not going to change the policy as it stands. All right, you moved over to the next slide already. Okay. SBA Express maturities, this is a big change. We changed the Express maturities from 7 years to 10 years. However, if you're providing a revolving line of credit on that Express loan, it can only have a term, it has to have a term out provision equal to the draw provision, so the draw term. So if you have a 5-year revolver, then you can term it out for 5 years to ensure an orderly repayment of that maturity, that outstanding loan balance. We were running into cases where the lenders were providing a 7-year term, and then they would have 3 years or less to term that out on a revolving line of credit, and it was causing those loans to go into liquidation and artificially inflating our liquidation rates and putting those loans in special classified assets on the bank's books, which no lender really wants. So we put these provisions in place to eliminate that from happening in the future. So that is something that is a significant change in the SOP, that we are requiring that term out period for not less than the draw period. Next slide. Steve's pretty much addressed the affiliation based on management for franchises. It's the same rule for non-franchise loans. So if the agreement, the management agreement, gives a third-party management company sole discretion over the management of the operations of the business, that is not an eligible transaction. So considered passive ownership with no input into the business decisions, not eligible. If it does not create an affiliation, then it would be eligible, and it may be eligible, but we have to look at it. If there is a finding of affiliation, you just have to incorporate the size of the management company into the size of the applicant business as well to make sure you determine that they meet the definition of small business. Because we are the Small Business Administration, we have to make sure our loans go to small businesses. Next slide. All right, equity injection requirements. I know this has been a little bit of an issue with some lenders. We have instituted a 10% equity injection requirement for all true startups. That is, they're going to hit the ground with this loan and start their business. They have not been doing operations. If they have an existing business and they have a sufficient net worth yielding a 9-to-1 debt to worth on that business, then they're probably pretty good to go. If they have a change of ownership, a full change of ownership, they will be required to input at least 10% equity injection. Most of the lenders I've talked to have said that this requirement is very favorable, and they like this change because it gives a bar, and they felt like some of the lenders who were advertising and pushing these 0% down, 100% financing transactions were kind of dragging them down into that area they did not want to be. Most of the lenders I talked to last week at Nagel actually told me they maintain a 20% equity injection requirement, and they're going to still maintain that because we just say a minimum of 10%. So they can require more. We can request more if the situation dictates that. It's just that is the minimum standard. For equity injections, we can allow seller debt, seller take-back note, to count as up to half of that minimum equity requirement. So they can project 5% for that seller take-back note, but that seller take-back note must be on full standby for the life of the loan. Debt is debt, equity is equity, and a seller take-back note as equity must be on full standby for the life of the loan. We do not want our funds to be paid out to the seller before our taxpayer funds get paid back to the lender. The guaranteed funds get paid back to the lender. So if the loan's on full standby, we can count it as equity. If it's not, sorry, it's debt. You have to count it as a global cash flow and make sure everything cash flows to debt service. Next rule on EPC. All right. EPC eligibility. EPC OC rules, everyone should know, changed on September 20th with the catch-all rule. SBA's intent was to assist with the preservation of a business that otherwise might cease to exist or cease to operate due to the departure of an owner, facilitating a withdrawal of capital out of the business. So if an owner wanted to leave, this would now permit the remaining owners to borrow those funds to pay off that departing owner instead of having to drain the cash or other assets out of the business to that transaction. It's not SBA's intent to facilitate flipping of commercial real estate, so there is a requirement that the selling owner must have held their ownership for at least 36 months prior to the loan coming in for application on an EPC change of ownership. We also applied the same guarantee requirements for stock redemptions and transfers of stock to existing owners, which we've had in the SOP for years. And when I mentioned this at Nagel, I think a light bulb went off on a lot of lenders who may not have understood that the SOP currently, the 5010-5I, currently says that any remaining owners, regardless of their ownership, must provide a guarantee. So we were getting a lot of questions. What do you mean if there's a 4% owner and they're going to stay on, the departing owner is leaving and they own 50%, that 4% owner is only now an 8% owner, that you can't require their guarantee? Yes, we can. They are getting a benefit from this loan by the increased stock percentage, even though their stock number may not have actually increased. The consideration on that is their percentage of ownership in that building goes up. So That is a requirement. It has always been a requirement on a stock redemption or stock purchase on a partial change of ownership between existing owners, and we just carried that over to the EPC. So you'd have thought I shot a puppy on stage when I announced that up at NABLE. Anyway, no, I do not, but the reaction I got at NAGLE seemed to feel like that. Anyway, we got a couple of examples for this EPC OC situation and how these will work. The first example, we have a case where there's an operating company formed and a real estate holding company owned by the same three individuals equally. They all own 1/3. Manny, Mo, and Jack formed the operating company, and they formed the holding company to purchase the real estate back in 2010. Each of them owns 1/3 of both of the companies, and now Manny wants to sell his interest in both the holding company and the operating company to the other two, either as a stock redemption or sell the stock back to them equally. It does not matter. And then he wants to retire. Prior to September 20 of this year, this loan purpose would not have been eligible because the EPC pivoted from allowed loan proceeds for any purpose other than the acquisition of eligible fixed assets. Now we can allow the stock transfer in an EPC amongst existing owners. So effective 9/20, this is eligible. 9/19, this situation would not have been eligible. So now it is. All right, next slide. All right, example 2, we have a situation where Manny, Mo, and Jack formed a corporation to purchase real estate in which it built a building that it leases 100% to the second corporation, the operating company, MMJ2. All three owners want to sell 100% of their stocks in the EPC to Jill, but not the OC. Jill is seeking a 7A loan to buy the stock of the EPC. This is not an eligible use of proceeds. It was not before, and it is not after, because Jill would now be considered a passive investor, and unless she meets those EPC rules and Manny, Mo, and Jack still guarantee, that's the only way it would be eligible. But Jill cannot buy the stock. She would have to form a separate entity to do that. So you cannot have an outside investor come in. It has to be the stock purchase amongst existing owners. So because Jill's an outside individual, she cannot come in and buy the stock of the EPC. So that clarifies it. Example 3, we have a situation where the EPC-OC structure and the loan is being made to the EPC and the OC as co-borrowers, because the EPC is buying the real estate and the operating company is acquiring the existing business, including the intangibles and working capital. Under EPC rules, you cannot use proceeds for that. However, we have clarified in the regulation and in the SOP that when the EPC and the OC are co-borrowers, you can have those kinds of proceeds used jointly. So the EPC can borrow the funds for the construction of the land and building, and the OC can borrow the funds for the business acquisition, including intangibles and working capital. It can all be rolled into one loan as an EPC-OC co-borrower situation. So this did not change, but this was clarified because there were a lot of people confusing that, and we had a lot of issues and questions from the center. All right, the last example we have is a situation that is not permitted even after the rule change. So Manny, Mo, and Jack formed the corporation in 2010. They also formed the holding company in 2010 to own the real estate. They each own 1/3 of the holding company, and they each own 1/3 of the operating company. Now Manny wants to sell his interest only in the EPC and keep his ownership in the operating company, keep those dividends coming in while he's sunbathing out in Tahiti. Unfortunately, because this is an EPC-OC situation, The ownership of the operating company are considered associates of that borrower. So this would be considered a loan or made where the proceeds are distributed, or it's a payment to an associate under 120-130A, which would be ineligible. So Manning has to completely go away from both the EPC and OC for this scenario to be eligible. If he wants to sell the EPC, he also has to sell the OC. The case is reversed slightly if he owns the OC and he also owns the real estate, and he just wants to sell his interest in the OC, and the real estate is not an EPC, if you understand that. It's just a holding company, and now Manny becomes the landlord with no association to the operating company. So he is not an associate of the operating company. He just becomes the landlord. That would be eligible. So I hope that clarifies those situations. And I think that's the last of my slides on this. I tried to go through quickly, but...
Well, I'm going to go through my slides real quick, and then we'll open it up to questions. How's that?
That sounds good.
Because I'm sure there may be some questions in regards to your examples. And I just have a few tidbits I want to throw out there really quick. A reminder, 7A questions at SBA.gov is our loan processing center. They receive hundreds and hundreds of questions, and a lot of them come from you, our field, which is fine if you're sending over questions in regards to eligibility. However, when you send questions over to them, or myself, to Bob, to Diana, to anyone where you need questions, please provide us with detailed information, including, if you have them, the account numbers. What happens is we get a lot of emails telling us to just scroll down and read it. And I kid you not, I went down 20 emails. I still didn't know what the lender wanted. I asked the LRS, hey, what does he want? And the LRS told me, I don't know. So again, if you get these requests and that you want to forward over, please provide us with just one email. Just put it in one email with all the information so that we can review them quickly. And especially for those 7A questions, I see them going back and forth, and then come find out they're servicing questions, so they should not be going to the processing center. We have servicing offices that can answer all your questions with the account number. So please be sure to include those in your questions. 4506T, I can't remember which LRS notified me of this. I'm sorry, but good comment here. There is a little box down at the bottom indicating that the signer is attesting that, yes, this is true, I agree to it. Many of the lenders are getting them back because they are not filled out, so they're causing delays. Please remind your lenders to click that attested box. Many of you may have missed the call that we have on our new website, our new wonderful website that everybody just loves. That was a funny. Anyways, so I went through and I got some quick links for you all to share. So, and I'll try to get more and do one of my little quick contacts links to send out to you so you have it all on one email. Please give me some more time to do that. And the servicing matrix. I got a little scoop there. Our servicing matrix was posted for, what, 1 day? And many of you picked it up, which was really, really great. The only thing is, it does not go into effect until January 1st. So they took it down because they don't want our lenders to be using something that does not go into effect until January. So please, if you have shared it with your lenders, be sure to remind them that those rules do not take place until January. We also have, I forgot to mention that, I don't know if I did in the slide, on the lines of credit. The new lines of credit, we've actually had lenders trying to do that, how to input it into the E-Trans system. It will not work because it doesn't go into effect until January. So many of your lenders are starting to use our rules that don't necessarily go into effect until January 1st. So please, let those lenders know. And I think that was my last tidbit. Oh, no, I forgot. Office of Economic Opportunity. They wanted me to remind you that it's time to do your micro-lender reviews. As you see, they're a little bit down as far as their approved loans year to date. So again, if you can get out there, do those micro-lender reviews, you may be able to answer some of their questions and their concerns so that we would be able to approve more loans. So please get out in the field, and if you don't have the forms, if you have any questions, there's an email for you to reach our Office of Economic Opportunity for all your answers. And again, the save the date is coming up soon, January 9th. Call-in details will be announced later. Once we get them, of course, we'll share them with you. And how was that? It was pretty quick. All right. Does anybody have any questions, any comments, suggestions? Now's the time. We're all listening.
Just a reminder, you may place yourself into the question queue by pressing #2 on your telephone keypad. Voice over computer users, select the raise hand emoticon from the top toolbar.
We got Raymond. Raymond, can you open up his line, please?
Raymond, please press #2 on your telephone keypad so I may identify your line.
Hi, Ray. Can you hear us?
Yes, I can. Good afternoon. Hey, I apologize if you maybe answered this question because I had to take a call and so I jumped back on again. But my question is on seller financing in the context of a business acquisition. I understand that when the seller is financing the downstroke in a business acquisition, that it can't be more than 60% of the required downstroke, and it has to be on full standby for the term of the SBA loan. My question is, can the seller note be accruing interest during that non-payment period?
Yes.
Okay. If it is, I could see a
make
situation.
any payments of interest.
Right, exactly. They can't make payments, but it could be accruing. So, there may be a scenario where it's highly beneficial for, depending on what that rate is, for the business to want to.
We're not going to get into that. If we run into that issue, we can look at it. But if that comes into play, the center and the lender, if it's a delegated lender, will have to evaluate the global cash flow of that. And maybe that particular borrower doesn't need to go into business if they can't generate enough money to put down a 10% transaction. If they can't put the 10% equity, SBA has always had the rules in place that all borrowers must have sufficient equity invested to operate the business on a sound financial basis. And if they can't do that, they don't meet the CFR rules. So that's the provision we're trying to maintain, and we're trying to make sure that these borrowers are complying with. And unfortunately, we've had a number of lenders kind of try to skirt that issue, and that is not where we want to be. We want to make sure if this is a true startup or a true change of ownership, that there is sufficient equity invested, because there are direct correlations about the amount of money invested into a business and its chance of success. And we want to make sure these businesses succeed, and if they don't have any money invested, they don't have any skin in the game, what's to hold them there?
But no payments on the interest is allowed.
No payment on the interest is allowed, because that is a payment. So it would have to go on full standby. Full standby means no payments of interest, principal, or anything until our loan is completely paid in full.
Okay, thank you for that. That wasn't actually I don't think that was the question I was going to ask, though.
That was what I heard.
What's your question, Ray?
Okay. The question was, it could be beneficial for the applicant to want to pay that off sometime in the future. And when that happens, they may want to do a servicing request to, allow a payment, or the lender may find out that a payment has been made. And I guess my question to you was, what happens in that, circumstance 5 years down the line if the applicant is requesting to be allowed to pay it, or notifies the lender, hey, I paid off this guy, so interest would stop accruing.
If they paid off a seller note prior to the payment of the SBA loan, they're in violation of that agreement.
Okay. So they would potentially...
SBA did not agree to it. SBA is putting a provision in that's saying if you're counting seller debt as equity, it has to be on full standby, no payments, period.
So there wouldn't be any opportunity for the services center.
They're in violation of that loan agreement. And, if they come into the center in 5 years and say, hey, he's in a good financial position, he has a strong net worth, and good debt to worth, he wants to begin paying this, that's a decision by the center, and SBA will make that decision at that point in time.
Okay. All right, thank you.
But as it stands, full standby for the life of the loan means full standby for the life of the loan.
Maybe they could request the payments coming to SBA first if they got all that extra money.
Yeah, pay our loan off first.
But Ray, I also wanted to thank you. You had sent in a couple. Was it you that found a little mistake in the SOP? Is that you, Ray?
There was. Maybe I just emailed one little thing. I don't think there was any big mistake.
No.
There was just a word missing, I think. There was nothing major.
Well, we appreciate everybody sending those issues into us so that we know about them. It's very important. So thanks again for taking the time to review that and sending us the email. Ed has asked a question about the 50105J. Is it on the new website? Yes, it is. And I provided it to you in those quick links. You can find the 50105. When you scroll down, and it may take a minute for it to load up to your computer, but once you click on that link, scroll down, and you will see every SOP because they have the archive, all of them all in a row, and the J is right on the top. So yes, the answer to your question, Ed, is yes. Do we have any more questions? Oh, I didn't know.
Yes, we did get another verbal question. Carl, your line's been muted. Please go ahead.
Hi, Carl. How are you?
Great. You? Hey, so just kind of as a follow-up question on the one where the borrower pays off the seller loan. I mean, we can't really punish the lender for that because the lender doesn't necessarily have any control over whether the borrower does that, right? So, I mean, if the borrower at some point pays off that seller note and then a few years later ends up going bankrupt, that shouldn't really affect the lender's guarantee, should it? Because the lender doesn't really have any control over whether the borrower does that or not, correct?
I actually had a case on my desk just like that a few months ago where the standby debt was paid off. And here it is in liquidation, and they're trying to do an offer and compromise, and it's like, wait a minute, where's that standby debt? How come it was paid off before our note? So we've had instances like that come through here. So as far as whether or not they're going to be penalized, is it going to be a repair or denial, that I can't answer. Can you?
Most likely it would be a repair if they paid off a standby debt and they acknowledge that. The lender has a recourse to sue the borrower for violating the terms of their agreement.
So the lender could actually put the loan in liquidation status and sue the borrower and then also request purchase even if there hasn't been any kind of a payment default on SBA yet?
They can't put it in it. They have to have a payment default to go into that. But they have to document their file of what they did, demand that that loan be remitted back to the borrower and injected back into the business as equity. And if they don't follow up with that, they've documented their file and covered themselves.
Okay, so as long as they document their file, they try to get the borrower to reinstate that loan.
Right.
You know, then they would be covered.
Well, I don't know if they'd be covered or not. It depends on the situation. We'd have to look at all the aspects of that particular case, and this is a hypothetical, except for the one Michelle got, and the one Michelle got, I believe we did a repair. So, you know,
well, I guess my concern is that we don't. I guess my concern is that we don't penalize the lender for doing, you know, for something that, you know, the lender didn't really have any control over. You know,
the lender collects the financial statements of the borrower, and they can maintain that, yep, that loan's still in place. If they see payments going to be made on that loan, I think that's when the lender has to go back to that borrower and say, hey, what's up? You're supposed to have this loan on full standby. And if they don't, and they just get these financial statements in showing continued reduction in that seller debt that's supposed to be on full standby, that's an issue.
Sure, yeah, I would agree with that, but I'm just saying that if the unknown to the lender, you know, after the fact they find out that that's happened, then we shouldn't be penalizing.
The story. Well, they may or may not be penalized. Tell us the story.
Okay.
If we think they did their due diligence, they probably won't be penalized. If we think they just made the loan and that was it and left the borrower on their own, then maybe they will be penalized.
Okay.
You're letting my crankiness come out.
You know what, though? I had another file this week. I think it was, what was the question? And I asked servicing. We had a business change ownership. They changed ownership, changed the name, and the lender is concerned about this because the borrower did this all behind his back. He knew nothing about this name change, ownership change, and I was told that the lender would not be responsible because they did not know. So in some cases, like Bob said, they may or may not have a repair or denial. You know, again, based on what concerns me is the same lender wants to give another loan to these people. So, but again, as Bob said, we've got to know the whole story. We can't just answer a lot of these hypotheticals knowing only half the story. And that's why we ask you, like when you send things in to us, tell us everything. Give us all the dirty details so that we know what we're dealing with. We don't want to give you a half an answer for your half a question.
Yeah, and we hear all the time, oh, the borrower didn't know he couldn't repay this. Well, that's not a correct statement. And, you know, well, the seller knows they have to also be on full standby because they signed the 155 agreement, that full standby agreement. And Pat Hayden just sent us a note saying SBA has recourse against the creditor who signed the standby agreement, and we do. And the lender has recourse against them if they've done a delegated process. So there is recourse to get that money back.
Does that answer your question, Carl? Do we help?
Yeah, I think that helps. I just want to make sure that you know, if there is an issue that the lender is definitely not responsible for, and despite actions to rectify the situation, you know, that they don't get penalized.
Well, you know, the lender's responsibility does not end at the closing table.
Okay.
Right.
I see. Thank you, Carl. I see Ed is still having problems finding that 5010. Oh, did he find it? Okay. Again, just a reminder, my links you need to be in full screen, full, is that what it's called? Full screen view in order for my links to work. But again, use those links for that 5010-5J because when you type it in, I'd ask them to use includes and not starts with. So if you start with your search with a different way that they have it included in there, it's not going to generate a hit. So unfortunately, we're still having issues, and they're still correcting all our requests. So for the time being, try using those links, and that could help you. Kim?
I just wanted to add to that some advice for the searching. Ed, you brought up a good point that you have your filters set to all. Sometimes, depending on how you get to the document lookup page, it might automatically be set to only include info notices or forms. So make sure you check your filters and keep your search broad. Don't search 5010-5J, just search 5010. And then also make sure you click the title, not the link that says download PDF, because if you click the title, it will show all of the versions, whereas if you click view PDF, it will just take you to the current version, which is I. So just some tips that we've learned from trying to navigate that site.
And again, we thank you for your patience. We know how horrible it is to, you're so used to going to one website, one link, and getting someplace, and now it's all changed. So hopefully we'll get some of those corrected soon, and we are trying to do it as quickly as possible. But again, we appreciate your patience during this time period. Speaking of time, we're running out. So does anybody else have any questions? Steve O'Lear, are you still on the phone?
I'm still here, yes.
Thank you again for coming on today's call.
You're welcome.
Appreciate you answering all those questions on the franchise. They know who to call, franchise@sba.gov. Thank you again. And everyone else, any questions? Any questions? Going once? Twice? Have a great weekend, and we'll see you next month.
Have a good holiday next week.
Oh, I forgot. It's Thanksgiving. Take care, everyone.
Thanks for joining today's conference. The call has now concluded, and you may disconnect.